Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Global equity indices and futures stabilise following large tariff-driven sell-offs, but the White House sends mixed signals on the tariff end goal. The EU Trade Commissioner says the bloc won't wait, quote, endlessly to negotiate. This as Europe proposes 25% levies on some US goods in retaliation for Trump's earlier metals tariffs. We will have the latest from Brussels. Plus, China vows to, quote, fight to the end after the US president threatens additional levies of 50%.
A quick check on these markets. You were seeing green on the screen this morning. A massive rally when you look at your stock 50 futures, higher by 2.3%. S&P futures as well, getting a little bit here, higher by 1.2%. Is this a fundamental shift in the narrative, or is this just people wanting to buy, people needing to buy? As you do see a bit into the stock market, you see a sell-off in the bond market, a 10-year yield at 4.17. That isn't really helping the dollar against the other havens. Dollar yen at 147.58. The countdown to the opening trade starts right now.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many countries that are coming to negotiate deals with us, and they're going to be fair deals, and in certain cases they're going to be paying substantial tariffs.
Donald Trump talking about tariffs yesterday. Honestly, who knows what is about to happen? Yesterday's session was epic. It was wild. Every time I checked the numbers, they were different. They were all over the place. The equity market was doing one thing, then it was doing another. Take a look at what happened with the US 30-year yesterday. It was a wild session. And I don't know if we're going to have another one today or whether or not things are going to calm down.
Yes, I mean, we don't know, do we? It was a really wild ride yesterday, and we're not getting clear messages from the White House, from the Trump administration, about what the end goal is here. So just to recap yesterday, we went up and down, up a hill and down a hill, basically, on stocks, didn't we?
Yep.
Risk appetite. After we got those rumours that there was going to be a 90-day pause, that was walked back, denied by the White House, and so stocks dropped. And then we got this news that there was the potential for another 50% tariff on China, and the markets just seemed to stare at that. Rabbits in headlights, because I thought that might drop stocks once again, but really we just managed to eke out a small gain. Yes.
It was quite significant the market didn't drop again on that, which some people are reading as a positive sign for equities.
I think it speaks to just how badly people want to buy right now, just how badly they want the carnage in these markets to stop, because at the same time that we're kind of debating what's going on with the equity market, the bond market had a complete U-turn as well, like something to the tune of 20, 30 basis points. I left here yesterday with a 389 on the 10-year. I'm looking at a 417 24 hours later. It speaks to this idea, and I think there's a couple here, that one, inflationary risk is now finally being priced into a bond market over growth. But then the kind of market plumbing of it all, which is maybe people needed cash. They needed liquidity so badly that they had to sell bonds. And we saw the element in the dollar. We saw it in the gold yesterday. And then it fled into the bond market.
Yeah, so the market dynamics really interesting. Banks perhaps selling what they need to sell, not what they wanted to sell, watching fiscal drivers around that bond market story as well. In terms of the steer we're getting from here, I think it's really interesting, the narratives we're getting. We're getting Scott Bessent talking about the US administration is talking to 50 to 70 countries. Japan will be at the front of the queue. You know, we're talking to all these countries. There are negotiations happening. And then Navarro's take is this is not a negotiation. But I wonder if we're confusing two things. Maybe Navarro is talking about the very short term. You can't negotiate this away in time for the imposition of certain tariffs tomorrow. But maybe longer term, and Scott Bessent is talking about a busy April, May and June, there is work that can be done on negotiating some of these tariffs.
I have no idea. I have no idea. I think it's interesting you talk about people wanting to buy stocks because they want the end of the chaos. I think my read would be they just want the end of the chaos. Do you buy stocks at this point? I think that's probably a more sober conversation going forward. There's a lot of damage that's been done. There's a lot of uncertainty that is going to exist for a while. So how much longer-lasting damage has there been done? We talked about the fact that the EU is waiting to respond. We are going to get something of a response, but the EU is unsure how to proceed and how aggressive to be at this point. And again, I think the point on time is important here. It's not going to wait for a long time to negotiate before it pulls out the big guns, but at the moment it is prepared to have that conversation.
We're talking about a plan getting released soon. We still don't have the exact details of what that actually looks like, but one that would get into force of April 15th. If the tariffs kick in tomorrow, we're talking about really just 8 days later, so a week later for this to kick in. That does create a little bit of wiggle room for negotiation.
But that is response to the steel and aluminium tariffs. So this is sort of like one tariff drama ago.
Yeah.
Yes.
This is the European response to that.
But
they're still saying on the big question of whether they respond to the reciprocal tariffs from the Trump administration, they're still saying they prefer to negotiate. But to your point, Guy, they're saying we won't wait endlessly. That was the word that Maris Sefcovic was using.
I think it's crucial here, though, that and one of the bull cases that has been made and on the show from market participants is that not only that the other countries have to pull down. If they are doing match for match, eye for eye retaliatory tariffs, that's where the chaos that's where you sell. But if there is any element of we're going to negotiate, we're going to maybe put significantly less tariffs on you in response, that's actually a bull case for our market because suddenly there's clarity.
But Netanyahu tried that yesterday, and Trump was equivocal on whether or not it would work. And I don't know whether or not that is the case. If you negotiate with the US, what are you going to get out of it? Trump said yesterday, Netanyahu's like, we'll reduce tariffs to zero. And Trump didn't indicate whether he would take all of the tariffs off, whether he would take the 10% off.
Right. I think your point on timing is right. I think that perhaps we're all talking about things that might happen, but with very different time horizons. Maybe Trump just wants to impose these tariffs. Just nothing is getting in the way of that. But and then maybe you roll them back with negotiation.
Well, I was going to say, does size matter then? I mean, is Israel just the smaller trading partner? Does it matter more if you're the EU or if you're China, for example?
I feel that we're burying the lead when we talk about China last, because China feels like it's at the front of this story. Just a little recap here. So Trump imposes tariffs on China. China responds by increasing tariffs by 34%. Trump says yesterday that he will increase the tariffs by 50% on top of that, if China doesn't withdraw. Now, that, depending on which tariffs previously you include, takes you to, well, at least north of 100 in terms of the import tariffs that China will have to take. It needs to be China needs to withdraw today. Otherwise, in theory, tomorrow, the 9th, those additional tariffs go into place, which would be epic in terms of global trade. So that's where we are. But China is in no mood, it seems, to back down at this point. It's talking about fighting to the end. It's put the national team to work in the stock market. It's fixed the yuan at a really cheap rate, which I think is significant as well this morning. That's a direct threat. There's the shine warning this morning. China ain't backing down, folks.
Yes.
And that is the big clash. We can talk about the EU, which is significant, but China versus the United States on tariffs and an escalating tariff war, that does some damage.
And Bloomberg Economics, on the previous iteration of this, before Trump said what he said yesterday, Bloomberg Economics said that you will unwind this trade relationship by the end of the decade at the rate of tariffs we're going to see imposed tomorrow, even without the further escalation. So with the further escalation, does that mean you unwind that trading relationship entirely quicker than the end of the decade, which is, obviously within 5 years?
And we're seeing elements of that in the corporate space, right? You mentioned Shein, for example, in the fast fashion place. We've heard reports around Apple really amplifying just how much of their production line they're now changing from China to India, a pre-existing move that they had made during COVID and the COVID story there as well. Then you have to talk about Japan. We know the Trump administration and Toshiba are in talks as well. We know that the U.S. Steel and Nippon Steel conversation is one to be had. TikTok is still somewhere in there as well. And Vietnam is taking the Israel approach to the Trump administration in that they're trying to negotiate an easier deal. So in the absence of China, perhaps these other powers in Asia come to the forefront.
But China is still the elephant in the room in terms of the narrative, in terms of the scale of the relationship, because it's just so big. Its economic footprint is so enormous. Can the Chinese ring-fence their economy in the way that maybe the US is talking about ring-fencing their economy? Anyway, we have much to discuss. As you can probably surmise, there are quite a few variables at work at the moment, and there's lots of ifs and buts and maybes. We'll try and figure out some of those ifs and buts and maybes today. Catherine Nice, PGIM's fixed income chief European economist, is going to be joining us. Barnaby Martin, Bank of America's global research European credit strategy head, will be here around the table as well. George Debas, BNP Paribas Markets 360 European derivatives strategy head, is going to be joining us, and Ed Cole, Man Group multi-strategy equity head, joining us as well. We've got some great guests lined up to talk us through their views on what is a wild market, Chrissy.
Great guests and plenty of data to keep an eye on, because even though there are plenty of geopolitical risks around the world, plenty of data points to be keeping an eye on as well. We'll start off at 10 a.m. UK time. We do have a 30-year gilts auction. If you were concerned about kind of the market moves at the long end of the curve yesterday, it doesn't seep in to the global auctions we are seeing today, for specifically right here in the UK in that 30-year. A similar story at 11:30 a.m. We also get the German 10-year bond issuance as well. How much appetite is there to own debt right now? I skipped over 11 a.m. UK time, where we have the U.S. NFIB small business optimism. If you're concerned about tariffs hitting the small businesses in America, how worried are people? We know they're already worried. Are they worried enough to act on it? And then, of course, some commentary coming out of the Fed's Mary Daly a little bit later. The
commentary out of the Fed seems to be that the Fed, in aggregate, and Goolsbee was talking about his fears around inflation, so I think that's quite significant. The UK 30-year was up 20 basis points yesterday.
This was international, wasn't it? To your point, Kriti, that, we saw this move in treasuries, the market asking different questions yesterday of the treasury market to the one we'd seen last week, and that did go global to some extent. We did see yields across Europe going a little higher.
Absolutely, and I think there's a question here of what matters more, and this is what we keep asking our guests. Is it inflation or is it growth? And the panic move has still been growth concerns into the bond market. Inflation, because of the lack of that Powell put, has kind of taken a back seat until yesterday. Yeah,
I think people have had it bubbling away. Break-even's been picking up. We'll talk about it a little bit later. I know Val's going to hit the issues surrounding the 30-year yesterday and what we learnt from that. Who was selling? Why were they selling? Key questions I think we still need answers to. What else do we need to know this Tuesday morning? President Trump has indicated that the United States is holding direct high-level talks with Iran on its nuclear program, with the next round taking place on Saturday. He made the comments during an Oval Office meeting alongside the Israeli Prime Minister Benjamin Netanyahu. Officials in Tehran say they have rejected the idea of direct talks and have instead offered mediated talks in Oman. The billionaire Ken Griffin says the latest round of US tariffs amount to a hefty tax on families and are, quote, a huge policy mistake by the administration. The Republican mega donor is urging people to reach out to President Trump and encourage him to reconsider the tariff policy, which he believes will take decades, not weeks or years, to achieve its goals. And President Trump has ordered another review of the potential sale of US Steel to Nippon Steel. US Steel shares surged. There's definitely a tongue twister in there. US Steel shares surged.
Very good.
Seashells. Anyway, as much as 15% after the announcement, triggering circuit breakers and briefly halting trading. Shares closed higher in New York, though still well below Nippon Steel's $55 a share offer. The order gives new hope to the deal that was, of course, scrapped by President Biden over national security concerns. Rescue me, Kriti. What do I need to know here, apart from the fact that that was quite the tongue twister?
You need to know that this company, Nippon Steel out of Japan, is still very keen on investing in U.S. Steel, which is a struggling company, which is dealing with international steel tariffs and the volatility around the Trump administration. And there is still incredible appetite coming from this Japanese company that is integral to Japan to actually invest and have this cash infusion into the U.S., a conversation that the Trump administration and the Biden administration have both vetoed. We'll see if that changes.
Yeah, both stocks trading higher on that news. We'll see if anything actually moves on it, any policy moves on it. Coming up on the programme, we just heard about Ken Griffin. He isn't the only billionaire with tariff concerns. We'll check on some notable reactions from the business community. Plus, equity markets look set to rally. Stay with us for the European market open. That comes at the top of the hour, of course, and we could see some upside. Up next, underlying growth concerns continue to worry investors and policymakers alike. We'll dig into those worries next. If you have any questions, if you want to be part of these conversations around this desk, then please do get in touch. IB plus BBTV Go is the function on the Bloomberg terminal. This is Bloomberg.
The anxiety is, if these tariffs are as big as what are threatened on the U.S. side, and if there's massive retaliation, and then if there's counter-retaliation again, it might send us back to the kind of conditions that we saw in 21 and 22 when inflation's raging out of control.
Austin Goolsbee from the Chicago Fed talking about inflation. The Fed is, and we heard it from Powell on Friday, talking about inflation. he's talking about this because he's hearing it from business communities, he's hearing it from the wider financial sector. And to a certain extent, we saw a market reaction to that yesterday. Take a look at what happened with long-end yields yesterday. Both sides of the Atlantic, really big moves. Val's here with the details.
Yeah, Guy, yesterday the stock market rout really turned into more of a bond market rout. We saw a surge in long-end yields globally. This one behind me is the 30-year Treasury yield, 23 basis points higher in the last two sessions. Is this a worry about inflation concerns, as we heard from Austin Goolsbee there? Or is it perhaps de-risking going on in banks' balance sheets? Are they deleveraging in a grab for cash? This could also be about deficit concerns, Guy. We're heading into an economic slowdown, and already the Western world's debt to GDP ratios are very bloated. Lastly, though, it could be perhaps a worry that the U.S. is currently alienating the big buyers of treasuries, be it Japan, be it China, the U.K., or even Canada, all of those being alienated by the U.S. government in their tariff fight. We've now erased completely, and then some, the rally in treasuries after the April 2nd tariff announcement. 30-year yields are now 11 basis points higher since Liberation Day. And I want to note, Guy, this isn't just in the U.S. This is happening on a global basis. Take a look at the long end of the U.K. curve. Yesterday, it hit 25 basis points higher. That's one of the worst days for long end gilts since Liz Truss. And what's going on in Japan overnight? 24 basis points higher for JGB long ends. What is this move all about? Many people are scratching their heads, but we're very nervous about perhaps this is the early signals of a funding stress going on. I want to take a look at some front-end funding indicators, this being the two-year swap spread and cross-currency basis. We're starting to see early grumbles that this grab to hold dollars on their balance sheet might be coming. But what is notably absent from this, Guy, is a big, big dollar rally. We have not yet seen that, but maybe yesterday's move in the bond market is a signal that that could be ahead.
A lot of questions. We need to figure out some answers. Valerie, thank you very much indeed. Catherine Nice, Chief European Economist at PGIM Fixed Income, joining us around the table. It was a global move higher yesterday in long-end yields. What do you think it told us about how the market is perceiving the fiscal story, the economic story, the funding story? What are you reading?
So a lot of great points raised. I think, though, that there is a distinction between policy constraints in the U.S. and policy constraints elsewhere. At the minute, the market's maybe not really differentiating so much across regions as we've seen, and maybe we'll start to see a bit more of that differentiation.
What does that look like?
So, I think the reality is the U.S. has significantly tighter policy constraints, both on the monetary side and on the fiscal side, that is simply not there to anywhere near to the same degree in the euro area, even in China. So if we talk about the two other major economic regions. In the U.S., the Fed has already cut a fair bit. We have what looks like a fairly significant one-off price level shock that could risk triggering inflationary concerns. That will constrain them on the monetary side. And, of course, on the fiscal side, they're quite constrained because they're already starting from a high deficit position. If you have any slowing in the U.S. economy, that, too, is going to further erode on your government spending numbers at the same time that GDP goes down. So you've got a deficit number that's maybe starting to approach 10%. This is not the sort of constraints that you're seeing, for example, in the euro area. The ECB, they can cut. Inflation is basically at 2%. It is clearly not an issue that underlying inflation is too high or accelerating like we've seen in the U.S. It's much less likely that we're going to see inflationary consequences from the tariffs in the euro area. We can come on to talk about that. And, of course, fiscal space. The EU, the euro area, has way more fiscal space than the U.S. does.
Who wants to pick up on that?
so many angles. I'll do it. You talked about this kind of your area has more place to maneuver. The counter argument to that is simply that they don't, because if you do have inflationary shocks or even growth pressures in other ways, the European Union and European governments, even right here in the UK, have the pressure to, I want to say, the public benefits of it all, the healthcare, the social benefits, the other pieces of the European infrastructure. Pedro Sanchez over in Spain, as one example, is imposing 14 billion euros that he does not have in the budget to safeguard from these tariff measures. You say they have room to cut, but do they if they're responsible for all these other public services?
So I think we have to put the UK to one side because the UK has its own kind of set of issues. If we look at the euro area, I'm not saying it's easy for them to make these changes. I'm just saying relative to the US, they have way more scope to ease policy to support. I mean, if we look at, for example, the tariff impact, I would not expect a one-for-one retaliatory response to come from the euro area. The kinds of goods that the euro area tends to import from the U.S. are not really final goods. They don't go straight into the consumption basket. So the inflationary shock will be less. You also have to factor in that global growth will be slower. The euro area is a much more open economic region. There's a risk that China is going to dump a lot of that excess capacity. So there's all these deflationary pressures, and there isn't that big inflationary push. And the starting point for the ECB is much cleaner than it is for the U.S. because inflation already is basically at target. So I think that does, other things equal, make it easier. We can then talk about the fiscal.
Well, let's talk about then maybe pause on the fiscal and talk about the bond moves here, because the yield kind of moves that you saw in the German yield prior to all this tariff announcements was pricing in fiscal spend over the next 10 years. How believable is that fiscal spend? How believable are yields at where they are right now?
Well, who knows what they're going to announce and how quickly. I do hold out some degree of optimism that, with Germany having taken this bold step forward, breaking, smashing through a couple of political red lines to get through significantly higher defense and infrastructure spending, that they're sort of leading from the front, and we see more initiatives like this. I think we could see perhaps, we're seeing some leaks in the press around EU bond issuance, something that looks a bit more grant-like, but perhaps just a fraction of the size of the kind of package we saw during the pandemic. We could see, a coalition of the willing also forging together. So a European, not an EU vehicle, financing vehicle to support defense. We've already seen the EU water down and ease and change some of its fiscal spending rules to give member states more discretion. So all of this, I think, is still to play for, and could, lead to higher long-term bond yields for macro fundamental reasons.
So it's really interesting then that you're suggesting that the inflation story stays more in the US than elsewhere, and therefore there's more flexibility in the rest of the world, certainly in Europe. You mentioned China in passing, Catherine, so let's go there. We've just had the foreign ministry briefing taking place, as it does every day. If the US wants talks, it should show respect, according to the Chinese foreign ministry. This doesn't necessarily sound like something that goes away quickly, this recent ramp-up in rhetoric.
No, it doesn't. And I think, this is, I was thinking about this last night, this is basically like, we experienced it here. This is like the cliff edge, the hard Brexit on steroids. So there is a real risk here that you get a disorderly, decoupling between the U.S. and China. And I think that's something people are worried about. And coming back to Europe, this would be another reason to think the net effect is going to be quite disinflationary for the euro area, because all this Chinese excess capacity, where is it going to go? I mean, the EU is the third largest economic region. It's very open, relatively speaking,
to
China.
Dumping in Europe, apparently.
Yes.
We'll see how alert we can be. Catherine, thank you so much. Catherine Nice, Chief European Economist at PGIM Fixed Income. Thank you very much for joining us. So Treasury markets in focus, European bond markets. I got a note from Berenberg this morning saying the UK fiscal outlook is not exceptionally bad. Everything we thought we knew about bond markets, it seems, being revisited in the last 48 hours.
Well, just the fact that the UK is actually holding up relatively well to the entire global economy. You see it in the bond market. You see it in the stock market. I mean, yes, they had declines yesterday, but less than everyone else. We even see it in the currency market. Cable flying this morning.
Let's see where the pain in corporate debt markets falls, shall we? We will talk about that next. Corporate debt markets, are they the canary in the coal mine for more market volatility ahead? Bank of America's Barnaby Martin joins us next to discuss. This is Bloomberg. Welcome back. 7:30 here in London, 8:30 in Paris or Berlin. Let's have a look at the equity futures picture. After the heavy selling of yesterday, we are expecting a little bit of a bounce, just a small bounce, considering the losses that we've seen over recent days, Thursday, Friday, yesterday, of course. We are, though, expecting to go a little bit higher. Will it last? Let's have a look at bond markets. We've actually seen German bonds pretty steady in early trading. The European bond market story not moving about too much. We've talked a lot about how we've seen yields going higher at the 30-year end, 2-year end coming lower. That's been the US Treasury story. That continues to be the story this morning. And that sort of went global yesterday. And so a lot of our conversation so far this morning has been about that bond market move.
Absolutely. And the ripple effect perhaps into credit markets as well. Let's go there next, where they've seen some of the biggest moves since the early days of the COVID-19 pandemic. Investors fearing an escalating trade war could ultimately lead to recession. Banu Baweja from UBS drew the link between credit spreads and equity valuations. Take a listen.
The last shoe to drop, which has only now begun to move, is credit spreads.
Yep.
Yeah.
They haven't moved as yet. So they have only now begun to move. And so valuations in equity, I think many equity investors miss a trick in not looking at credit. When high yield spreads stabilize is when U.S. equity valuations stabilize. When equity valuations stabilize is when the market stabilizes. High credit spreads are likely to widen out. And every 100 basis points widening of credit spreads, we think, is about 1.5 times lower in the forward PE multiple of the S&P.
Banu Baweja there, the chief strategist at UBS Investment Bank, talking to the show yesterday. Let's bring in another expert here. Barnaby Martin, head of European credit strategy at Bank of America Global Research, joins us around the table. Pleasure to have you on the program. Good morning. Is he right? Are the credit spreads telling us something that the rest of the market needs to listen to?
I think they are. I think they're saying that the hubris that's been in corporate bond markets for the last 2 to 3 years is finally cracking a little bit. Remember, this has been a really long bull market for corporate bonds. Spreads peaked in early October 2022. So this has been nearly 1,200 days of a bull market in corporate debt, which is a long, long time for corporate bonds to feel very, very rock solid. You know, during that time, things were buffeted tighter by all these central bank rate cuts. We had 300 central bank cuts in that period. It pushed €250 billion of money into corporate debt. The market came into this very, very rock solid, and of course, that was your catalyst for things being shaky. You know, hubris comes back to bite. So I think you do need to watch credit spreads. You know, I've been doing this for a long time. I was here in 2008. I didn't necessarily pick it up so quickly then, but credit was your canary. It was your lead indicator for greater corporate stress.
Let's talk about this hubris that you referenced there. So much of this zombification that's been in the markets that everyone's kind of knows is there but hasn't actively seen has been driven by the fact that it's really easy to refinance debt right now. How easy in the next 12 months is it to refinance?
Well, you've got to watch yields. So there's a lot of focus on credit spreads. And remember, in previous crises, whether it was COVID, whether it was the Russia crash, corporate yields went up. So debt was more expensive. When debt's expensive, there's less of it around, so you get corporate stress. Just looking at the market in the last 3 or 4 days, yields haven't really moved. So that could be unique, and that's being, of course, what's happening is spreads are going up, but because government bonds are rallying, your net all-in cost of credit for companies hasn't yet become really stressed.
So maybe that's something of a silver lining at the moment, although we're watching something different at the long end of Treasuries.
Well, we come into this after, you know, remember, it was only a few weeks ago where we had the German fiscal miracle. So bund yields went up. It was a great, if you like, starting point for yields to rally, which we weren't in previous crises. So a lot of the credit spread stress has been offset by what you're seeing in government debt.
Barnaby, you mentioned your experience in 2008, and before there was a GFC, a global financial crisis, there was a credit crunch.
There was.
So help us understand what defines a credit crunch. Are we in one now?
We're not in one now. I mean, a credit crunch is you just lack, as a company, you lack access to liquidity, whether it's through the banks, whether it's through the bond markets, etc.
And we're pretty sure that companies out there don't lack that right now.
Well, what changed, certainly in COVID, was Europe set up tools to allow companies never really to fail. I mean, wasn't it remarkable in COVID, our default rate in Europe was about 3%? Companies just didn't fall off the cliff. Largely, that was because across Europe, we set up these state-backed lending programs. You know, Italy, Spain lent tremendous amounts of their sovereign balance sheets in the form of liquidity to companies. So we have the tools. Do we have the means to do it? Well, look, corporate leverage and sovereign leverage is high, so I don't know whether governments are as keen lend in that kind of quantum again, but we have the tools to do it. So no, I don't think you can see the same level of systemic stress for companies. There will be idiosyncratic shocks. There will be those companies who realise, oh dear, my supply chain now is in real trouble. So you're going to get idiosyncratic stress. But a systemic problem for corporates, I think we have the tools to prevent that.
What did clients do yesterday?
I think they woke up and realised yesterday was the real deal, that credit was tight, that it came into this very tight vis-a-vis stocks, vis-a-vis German government debt, and they looked to hedge. Yesterday was the first day...
Hedge or exit?
I don't know if you can exit in a market that was so dysfunctional, but you certainly, when we started the day and iTraxx Main was 10, 12 wider, that told me that credit was leading equities. So Thursday, Friday last week, equities were selling off more than credit. Yesterday, that flipped. And it was credit leading the underperformance, which told me that people were trying to get out of longs.
Trying to get out of longs?
Yeah.
Equities Thursday, Friday moved a long way.
Yep.
They moved a long way Monday as well. As you say, as you imply, credit's come relatively late to that sell-off story.
Yeah.
What's the kind of value? In theory, they're relative. They're almost the same assets in so many ways in terms of the hierarchy. Equities have obviously dropped quite a long way. Credit hasn't dropped as far. How much further does credit need to come down to match where we are with the equity?
Well, I think the one thing we need to talk about is, does money leave the asset class?
Yeah.
Because remember, in COVID, that tremendous month of March, you saw 80 billion of money being pulled out of credit, which made the sell-off all the more dysfunctional. Now, at the moment, spreads have moved, but money hasn't been pulled out of the asset class. Largely because the market keeps thinking, well, the ECB is going to come to the rescue. So rates go down, I keep buying bonds in Europe. If money leaves in the next few weeks, we could see much more disorderly price action.
You said it was a hedge, not an exit. Explain the hedge.
The hedge is to lift your liquid indices of iTraxx or ETFs. You know, typically in periods where risk is very, very extreme, it's quite difficult to get out of longs that you've spent months building up. So I thought yesterday was a hedge, which really is explained by the price action in iTraxx in the morning.
Bonby, what are we looking for from the ECB then? You've referenced how they've employed a lot of tools since the GFC around COVID and other crises. Do they have all the tools they need to respond in this, or do we need a conversation about new tools?
No, I think they do, but I think most importantly next week it's about recognising that it's not a good time to pause. You know, go back a few weeks and the debate at the ECB was maybe we'll pause, right? Maybe we'll see the German fiscal policy is potentially inflationary. We'll take the April meeting off and we'll see how things go. I think that is a risky strategy now. I think they've got to deliver 25 bips next month. Then perhaps the debate is, do they do 50 quite soon?
Because our last guest was similarly saying that the ECB will be cutting and that the inflation stays largely, I paraphrase, but inflation stays largely in the US.
Yeah, this is a demand shock for Europe. You know, the hawks at the ECB who want to entertain the idea that this is an inflationary shock, they're in the minority. This is a demand shock for Europe. The US is a big source of our demand for export, so that's gone. The ECB's got to respond because we're going to undershoot 2% inflation on the back of the shock. So, look, ECB will do what the ECB does, which is continue to cut back to back.
So is European credit a safer bet than US credit?
Well, you've got two things that work in its favour. You've got the ECB continuing to cut to 1.5 by September. You know, and also let's have the debate. Do they have to go lower than that? Could we be talking about an ECB to 1%?
Do you think they will?
The risk of that's gone up because what Donald Trump did, you know, tariffs on 211 companies was a game-changing moment. So without doubt, the ECB need to entertain whether they have to go lower than 1.5. Secondly, Europe can respond. It's got tools to prop up its sectors that, you know, autos, for instance. It could do targeted fiscal policy. The US is a different ballgame because there is stagflationary risk there. Jay Powell is in a tricky situation. We at B of A don't think the Fed cut. We think they're on hold this year. So you've got significant central bank divergence, and you want to be in the bond market where your central bank is backstopping you.
Does that incentivize more corporates to issue more debt?
Well, I think over time you could have the return of the reverse Yankee, so US firms looking to issue in Europe. I think probably everyone, you know, if you're a corporate at the moment, you're just waiting it out and seeing where rates are going, because even if the Fed isn't cutting, 10-year Treasury yields until yesterday afternoon had a big move lower.
Is there enough European buyers for that, for the return of the reverse Yankee?
For the right name, for the right duration, there's definitely buyers,
Does that squeeze out worse European names?
I think to an extent, But it could also steepen the credit curve as well. because US issuers tend to issue long-dated bonds, so it does create a bit of curve steepening in Europe.
Okay. Wow.
The return or the reverse Yankee?
Yeah.
I think that's the line this morning.
It's amazing. Pretty stuck in that thought now for the next hour and 20 minutes.
It's brilliant. I learned one of my first beats at Bloomberg was Yankee bond issuance. So this is fabulous. Barnaby Martin, head of European credit strategy over at Bank of America Global Research, making quite the call about buyers of debt around the world. We thank you so much. Coming up, we're going to focus more on the corporate story. We're going to focus in on Rheinmetall after the stock's very volatile session yesterday. That story and more in today's Stocks to Watch. Stick with us. This is Bloomberg.
$16 minutes to go until equity markets start trading here in Europe. Who knows what happens after that? The trade war story, though, beginning to capture corporate imagination. We're trying to figure out whether or not you should be buying Apples or Land Rovers or whatever else you might want to buy in the United States now rather than later. That's what's catching Kriti's eye this morning.
I'm ready to spend some money, and except then I looked at what some of these prices actually look like, and they're a little worrying. UBS crunched the numbers of what an iPhone may actually cost. I want to drive into some of these numbers here because they did the tariff impact depending on where the phone or the Apple Watch, if that's your preferred technology, is manufactured. Let's start off here. iPhone 16 Maxes are mainly made in mainland China. With this tariff increase, we're talking about a 29% increase in the retail cost. Even if you do have this idea that Tim Cook, of course, has been celebrated for, which is moving some of the supply chain away from China into India, you are still looking at, say, a 12% rise for an iPhone 16 Pro that is manufactured in India. So you are still seeing pain there, even though there is this diversification of the supply chain. Similar story with Apple Watch. Even in Vietnam, even though the Vietnamese government is looking to negotiate with Donald Trump, we're still looking at a 19% increase. Here's why this matters for the stock market. Apple, of course, the world's most valuable company, driving a lot of the Mag 7 gains as well. Take a look at what it's doing in terms of profit margins, specifically for the iPhone. It has been growing since 2020, where we were talking about this kind of China COVID supply chain crunch, where that initial move to move away from China into India was really kind of increased and accelerated. Back in 2020, the profit margin was about 33%. It has only increased then for the iPhone. A lot of that kind of cost being passed on to the consumer, this desire for, and disposability, I should say, from the income space into the luxury market. And yes, Apple iPhones are luxury products at the end of the day. That profit margin is at 43% as of last year for an iPhone. That might all change if you do see these massive retail costs that a consumer cannot buy. And they're not alone in terms of starting to think about where it might hit. JLR, of course, and some of the major brands there already talking about limiting some of the exports into the United States. You have the same commentary out of the likes of Mercedes. Even just this morning, Guy and Anna, Shein talking about, or at least facing pressure from the Chinese government to limit some of their supply chains and some of their exports that go into the United States.
Yeah, lots of corporate news flow then to fully understand, or to better understand as we go through the days and the weeks ahead, as we continue to track where markets move around the credit and tariff story. Joining us now to think about the broader market picture, Bloomberg Executive Editor for Asia Markets, Paul Dobson. Paul, I'm going to ask you an extremely dangerous question. Is the worst of the sell-off over now? I mean, how can we possibly answer that, I suppose, unless we know what is in the minds of those in the White House?
Morning, Anna. Of course, that would be the easiest way to know whether the end is already with us. I think what we can say with a little bit more certainty is that, at least for now, there are some signs of stabilization in the market. Yesterday was the worst ever day for the MSCI Asia Pacific Index. Today we've got a bounce likewise, and I think we got quite a lot of information from the price action in the US day too, where we had markets down, then that really huge rally on the unconfirmed reports, which proved or were subsequently denied, about the idea that the tariffs could be pushed back. And we wobbled around after that and then stabilized a little bit. I think what people took away from that is this idea that it doesn't take much for the market to rally quite a long way. If we see, the first country starting to get some kind of an agreement with Trump, some kind of way to moderate at least a little bit the impact of the tariffs, then people will maybe gain confidence on that and the market could find a surer footing. However, I think that another way to look at at it is, and this is from my colleagues over in Bloomberg Intelligence, they're talking about this idea that however longer that carries on dragging out, each day we don't have certainty, that uncertainty is bad for the profit outlook on companies. So every day that we don't see some sort of relenting in the tariffs, that's probably a bad news day for markets.
Paul, usually there's an asset class that leads. Which asset class is leading right now?
I mean, I think that people are paying more attention to the US equity gauges than to anything else right now. What we did see was that very big spike in the VIX as well yesterday. An idea that maybe, you know, people are just so confused now about what the direction could be that they're starting to get a little bit more worried. I think it was really interesting as well that we saw that big sell-off in Treasuries yesterday. Kind of counterintuitively, people have all sorts of explanations about why that could be the case. Maybe it was a forced liquidation in order to raise money. Maybe people were worried about inflation. Maybe people worried about what all the tariffs are going to do to the US spending. We're going to get auctions this week, so we'll see very clearly what that looks like in terms of demand. You know, but I think that for now, people paying first and foremost attention to what those headlines show and then what the stock market looks like after that.
Paul, very quickly, when do we see a bigger reaction in the currency space?
Well, the currency market has seen some pretty big moves. If you look at the Australian dollar, for example, not necessarily, you know, the G3 currencies, but there has been lots going on there. I think one thing to watch out for when it comes to that is what China does with the Yuan, which is quite important as that anchor. If it does start to let it go a little bit more, then that really could see a big whip up in currency market volatility right across the board.
Paul Dobson, Bloomberg Executive Editor for Asia Markets, we thank you so much walking us through the macro. Let's go to the micro as well. Get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So Rheinmetall holds an investor day today, coming off the back of a wild day for that stock. Remember, we opened down around 25% for Rheinmetall before recovering most of that, but still on a two-day basis, off around 8% for that stock. But investors, of course, still sitting on massive gains over the past year for Rheinmetall, given the uplift we've seen in the defence sector. But watch out for commentary on any earnings guidance from Rheinmetall at that investor and analyst event taking place today. Then in terms of energy, Repsol being called lower by a couple of brokers today, including Morgan Stanley, which says the refining margins at the Spanish company are weaker than expected, and that has been an issue for the stock and the broader sector over the past year for that firm. Though, however, do note that the stock has declined with the broader energy sector over the past few days, of course, given the tariff impacts, and potentially some of this is already priced into the stock, but one to watch at the open in Madrid. Then in terms of a bit of M&A, we've got Infineon in the US buying the automotive networking business of Marvell Technologies. Now, it's around $2.5 billion in terms of the layout for that deal. However, it's priced at 35 times earnings, so looking really expensive according to some analysts, and that is one of the favourite stocks across Europe. We can see 27 buys on the shares, not a single sell. Doesn't get much better than that in terms of the analyst ratings. Then in terms of a couple of downgrades to bring you, Pandora cut at JP Morgan following that recent sell-off, and we've also got a downgrade in private equity for EQT, and also AENA over in Spain, the Spanish airport operator, cut to sell over at Goldman. That one could also be weaker in Madrid this morning.
Thanks very much, Joe Easton, from our equities team with some of the stocks that could be on the move. But it's really a big picture market once again, isn't it? A bit of a bounce expected at the start of trade. US futures pointing higher. This is nothing compared to the losses we've seen already. So whether this sustains, we're all at the whim of Truth Social and Twitter and commentary coming out of the White House, it seems. The China story, we're watching that so carefully because if we are really talking, as Catherine Nice was telling us, about a disorderly decoupling of the world's two largest economies, then we will watch.
Trump says he wants the 34% tariffs that China has imposed as a result of Trump's 34 initial tariffs, not the 34. Today. They've got to go today. If they don't go today, then in theory,
we're
50% tomorrow. We're north of 100.
I'm curious when this all starts showing up in the data, because we kind of know how this will play out if they do indeed go into force or if we get the bigger numbers. But when do the markets, I mean, they're already selling off, but sell off even further or rally or position or exit when you have payrolls numbers, CPI numbers, the hard data that starts to come in that says the United States is suffering. We're talking about the Trump put not existing.
Yeah.
Is there a data put to be aware of?
Well, I mean, the latest data we got on Friday, the payrolls, that didn't tell that story, did it? So it was quite incredible to watch that. But we're absolutely watching for that. We get inflation numbers, don't we, later on this week? But again, a bit backward looking. I think you're right to focus us on the corporate side of things. I know you flagged a story around some of the autos makers helping their suppliers.
Yeah.
And we just had a really interesting conversation about credit markets. And our guest Barnaby Martin telling us this is not a credit crunch, but this is the kind of activity reaching down the supply chain, supporting the companies that supply you, that we've seen in those kind of periods of stress.
It's been a problem for the aviation sector. So I talk to Airbus about this all the time. It's been a problem for a lot. It hasn't really kind of fully recovered since COVID.
Yeah.
So that has been they're just beginning to get to the point where they can deliver the ramp. And here we are again with problems. You've already got people in the supply chain calling it force majeure. So you've got problems already. How much more amplified does that become?
I'm having a little bit of deja vu here, because if we're comparing this in terms of a growth risk and kind of a black swan risk there of a very fast global recession. So I'm going to go look back to 2020 as kind of the early roadmap there. One of the reasons that some of the companies had rallied or had survived in the credit markets and beyond, it was the tech names, not because they were diversified in their supply chains or anything like that. It was because they had so much liquidity on their balance sheets. They had so much extra cash, trillions, and they were able to access the market in a very fast way. Can the automakers do that, though? Can the Airbuses do that? Do they have that extra money?
And we were just all at home staring at our screens, which played to the tech strength, didn't it? I mean, that and pelotons and things that you could do to keep fit in your house.
Yeah, absolutely.
That feels like a long time ago, doesn't it?
That
feels like an
but the
awful
management teams have been tested by that, to your point about the aviation sector.
They at least have a greater understanding of what's going on within their supply chains to figure that out. But is this market cheap enough yet? Have we priced enough of this risk in? Do we understand how cheap the market needs to get? I don't know. The US market still trades on some pretty punchy multiples. The market open is next. Looks like we're going to see some green on the screen. That's next. This is Bloomberg. Tuesday morning, good morning. It's Tuesday. Session's about to start here in Europe, but let's talk a little bit about yesterday and figure out exactly what happened. I'm not sure I have all the answers. Gap lower first thing. European equities drift into positive territory. We basically go sideways after the gap lower. Then we get this. And this is the insane moment that the market went through yesterday as we tried to understand whether or not tariffs were about to be delayed, deferred, pushed back by 90 days or not. The market's all over the place at this point. Every asset is all over the place at this point. This is equities, as you can see, European equities mirroring US equities. The US had only just kind of got up and figured out what was going on at this point. At that point, we don't know. We still get a lot of news throughout the rest of the day. We talk about China retaliation and then further retaliation to the China retaliation. But the market barely blinks at this point. This is the crazy moment. What did it tell us? I don't know. I don't know how much we learned from it. But it did tell us that this is a market very much on edge, Kriti.
A market very much on edge. Perhaps a market that's hungry to buy. At least that seems to be the sentiment when you look at the futures picture. Anna, the outperformer this morning is Euro Stoxx 50 futures higher by 1.8%. The DAX, the CAC, that's where we're focused on, higher by 1.4%.
Yeah, let's dive into some individual company names. It might not be a day for individual stories to cut through, but sometimes they do, and they might today. Infineon Technologies agreeing to buy Marvell Technologies' automotive Ethernet business. That's $2.5 billion in cash. So there is still some corporate activity taking place, which capital markets activity. Repsol in focus. The first quarter upstream production numbers out of the Spanish energy company missing estimates. So we'll watch that one at the open. And also keep an eye on the healthcare company PureTech. It's in talks with Nordic Capital Epsilon on a possible cash offer. This according to a statement. Guy.
OK, let's go top down. Let's figure out what's happening. It's time for the opening trade. Yesterday was a crazy session. What are we about to see? We're expecting markets to open in positive territory. Equity markets, cash equity markets, and we're getting that from the FTSE 100. We're up by 0.2% at the moment. How much higher do we go? How much volatility do we see in the session? The VIX is going to open in around 15 minutes' time. We'll get a temperature check on what is happening with the market at that point as well. Stock 600 is up by 0.7%. The IBEX is up by 1.1%, 1.2%. We are seeing some green on the screen. Feels like a long time ago that this last happened to European markets at the open. So we've got a positive session. The CAC is out of the gate fairly quickly. We're up by 1.6%. So some green. Anna and Kriti, what does that mean in terms of the sector story? What's coming back most strongly?
Well, it is, to your point, you are seeing a bit of breadth. I was expecting most of the stocks, except all of the stocks, to be in the green, that buy across the board. You were not seeing that element. From an equities perspective, your laggard this morning is utilities, but everywhere else is green on the screen. When you look at index contributions, tech is leading the charge. I'm looking at ASML, Schneider Electric, SAP. Those seem to be the big movers to the upside, but then your big kind of commodity names as well. If you're a large cap in Europe, Anna, this morning, you are rallying.
Right. I mean, I was looking at some of the sectors that have done well month to date, and we do see a bit of a reversal in that. So utilities, grocery stores, real estate, these were all doing pretty well month to date. That's on the back of fears around recession and going into some of the bond proxies, perhaps. And, you know, we're still going to need to buy groceries and some food and some beverages, it would seem. So those were the trends. And so we're seeing some reversal of that this morning. But it only scratches the surface, really, doesn't it, compared to the losses that we've seen of the last few days. Energy stocks on that same theme, month to date, they were an underperformer because of the links with growth, and energy is the best performing today as oil prices bounced by just 1%.
458 stocks up, down 76, unchanged 65. There's a story just crossed the terminal which I thought was quite interesting. Porsche's Q1 China deliveries down 41% year on year. That's a number worth paying attention to.
Yes, for Q2,
and that's
Q3.
the before of the announcements, right?
Anyway, the stock is... the autos have been so battered, the stock is tracking a little bit higher this morning. But we are certainly seeing a much more positive market. It's unsurprising that the outperformers recently, the safe havens, the utilities, are doing better, are doing worse today after having done so much better. But it's a fairly eclectic mix in terms of where we're seeing the percentage gains coming through at the upside. But from a points point of view, ASML, Shell, Roche, Novo that are coming back the most strongly. These are sectors that have been battered recently.
Coming on pretty strongly, but I mean, these moves are pretty, to Anna's point, not as big as the losses that we've seen, but these moves are pretty decent. We're looking at ASML move here of just shy of 4%. That is a pretty gigantic move that we are seeing this morning. Let's see if it sticks. I'm going to ask the true expert, George Debas, head of European equity and derivative strategy over at BNP Paribas Markets 360, joins us around the table. He's had a quiet couple of days, so naturally we bring him on the show. George, we keep hearing, Emmanuel Cao from Barclays this morning had made the comment on Bloomberg TV that there is no put on Trump. How do you trade a market that has no Trump put?
It's very difficult to trade a market when a lot of it is dependent most probably on a single individual, which by nature is quite unpredictable. So it puts us a bit in a difficult situation. It becomes a lot easier if you're a long-term investor and you want to actually start buying stocks that have derated a lot, that are attractive, like ASML, all while understanding that on the short term, you might allow yourself for a bit more volatility. But as long as there is uncertainty in the market, I think it's a bit more prudent to be cautious and hence have a bit more allocation to defensive, either indices or sectors or companies, than necessarily trying to go full-blown and buying the stocks that have completely derated on the short term.
So I've heard in some of the commentary in the aftermath of this kind of market carnage that we've seen that there's going to be not just a structural shift in the global economy off of these tariffs, but a structural shift in the way that the stock market not only operates, but the companies that have been kind of having that leadership. In the absence of this structural shift, or in the time that it takes, why not buy every dip?
Well, the current issue that we're currently having and the investors are facing is a rising risk of a recession. And that is stemming from an uncertain environment which is led by a paralysis because investors and also corporates are not really willing to do bigger investments as long as there's no real clarity around what's happening with the trade tariff. So with that uncertainty is happening, brings a lack of confidence in investing, which also brings a lack of growth with it, on top of the direct effect that you have from trade tariff. So in that environment, you have a probability of fundamentals going a bit lower. And as long as fundamentals are holding up, it's fine to buy the dip. But if they start turning south and you have negative earnings revision and also a negative GDP, then the downside scenario, especially if we do actually enter a real recession, is quite material.
Let's talk a bit about the volatility we're seeing in markets then, George. And I was looking at the VIX. It's higher now than it got to during the financial crisis. It is closing in on COVID levels.
Correct.
The VIX. I mean, looking at the futures curve, colleagues pointing out that suggests that volatility could be here to stay. It's not going away quickly.
Yes.
What's your assessment?
I would agree with them. I would say the velocity of the market reaction post-Labor Day has been so big. So I'll give you just a quick stat. The S&P 2 days downgrade and Eurostoxx, the 3 days downgrades, have only happened during Black Mondays, Lehman Brothers, and COVID. These are 3 very big days. So in that respect, VIX and volatility tends to react to spot, and spot's reaction has been quite extreme. So it does make sense the volatility has reacted the way it did. We do expect it to remain elevated in the sense that as long as there is unpredictability, there's no reason for volatility to come down. But will it remain at these levels? It's going to be a bit difficult in my view.
Difficult for it to remain up there.
Up there.
Yes.
Elevated, yes, but at these levels,
Because recent spikes in the VIX seem to have been unwound pretty quickly, or
Correct.
increasingly quickly, seems to be the message coming through from our derivative strategists here at Bloomberg. What do you observe in how quickly the VIX recovers?
So within the VIX, actually, if you look at history around these type of shocks that happens, where the VIX and the VSTOXX are these type of levels, a month, 2 or 3 after, you tend to have a reversal 5 times out of 6. So you're right. Spot, on the other hand, could drift continuously lower. So you could have continuous market reaction, but not necessarily with volatility that increases from these levels. What we've seen from both our position indicator and also from, maybe anecdotally, from the flow that we've seen internally, are indeed that we've seen more people coming to unwind some of their hedges, selling some of the volatility, than increasing their activity and the hedges at these levels. So we haven't really seen panic, as you would usually have seen when VIX is at these levels or VSTOXX are at these levels. We've seen the other...
Good to know this isn't panic, then.
Yeah. So what's demand for hedging like? And I'm assuming a lot of it's puts. Talk me through what you've seen.
So we've seen more unwind of hedging than desire for new hedging.
Okay.
So what has happened, in our view, is post-Liberation Day, the market has realized the probability of recession, or maybe taken the Trump administration more seriously, has materialized. And so there was correction in the probability of recession. Entering into the event, the probability of recession was too low. Because at the end of the day, the impact on the economy and the tit-for-tat retaliation is something that was expected. But as soon as people finally understood that now it needs to feed into your probability numbers, it allowed a market reaction where investors decided to degrow some of their risk book. Because coming into the event, most investors were still long equity market. I mean, it was only 2 months ago we were sitting here talking about U.S. exceptionalism. And 2 months later, we're talking about recession.
So the market doesn't feel, given the potential for this to escalate, that it needs to hedge some of that risk still? That risk has been... We've moved through that event, and we're post that event, and it's now... You basically reorganize your portfolio.
I think a lot of the reorganization has already happened.
Okay.
And most of the investors that we've talked with were already starting to hedge pre the event.
Right.
Not post the event. They've allowed this event
But does that imply that they don't think that it's going to... that there are not big risk events still to come? That the worst of the risk event is now over?
No, I think... No. Sorry, let me rephrase that.
Yeah.
The risk events are still very much present, but because they're very much dependent on one person that can relatively change the narrative very quickly, given that this is a crisis of confidence, it's not one of over-leverage in the system or systematic issues, we can change the narrative very quickly, and we can go back to actually almost all-time highs in the near future, if possible. So that's still part of investors. So people are not want to very quickly change all of their exposure if... like you said yesterday, in a single tweet, you could see the intraday being about 5%. So if you switch all of your book and all of your exposure and you start hedging too much of the downside and you're very much dependent on an article coming out that could switch a lot of that, you'll be on the other side of the trade very quickly. And I think people are taking that into consideration.
Okay.
Is there a cross-asset signal that equity markets specifically are watching? In the bond market, the currency market, the commodity market, if you want to put it, is there a signal from another asset class that's moving equities?
I would say right now, talking internally with some of our investors also, I think the credit market is the one that we're looking at in general. But a week ago exactly, the equity market compared to other asset classes were portraying more downside risk. So we were leading the curve. It looked like others were still misinterpreting the potential risk of the last week. But right now, we've seen a repricing across all risk assets in that respect.
Our last guest talking about credit was suggesting that we wouldn't get a credit crunch as we've seen in previous crises because banks will play an important role here. This is retail banks providing funding for their customers and also central banks.
Yes.
Would that be your assumption as well?
Yes, and I would also say, I mean, he's the credit expert, but I would also say there are a lot less leverage in the private sector and the consumer than was previously, and that's why people are a bit less worried about a prolonged downturn outside of the unpredictability that we can have.
Just coming back to options hedging, is the expectation that the market is going to continue to swing from one side of the V to the other side of the V, and that we don't, we've spent a lot of time within around the centre of the distribution of outcomes, but actually are we going to continue to swing from one extreme to the other? And if so, what kind of a hedge are people putting on in terms of the? Do you put a strangle on at this point? You stay in the middle. What are people putting on?
Yeah. So I would say at this type of level of both volatility and skew, the simple downside puts or put spread are the one that actually makes a bit more sense. Okay. Especially the put spreads one. At these levels, buying a strangle or even a straddle is expensive if you don't trade it and you don't realize your gamma. In that respect, because the volatility has gone back so much up that the probability that it realizes on its own without actually what we call data hedging becomes a bit more difficult. So in that respect, what we say to investors, if you want a downside, if you want to offer yourself some downside protection, depending on how risk exposure is your portfolio, you should actually simply buy some put spread and or actually reduce some of your exposure at this type of volatility.
Okay, that makes sense. Been nice to see you. Thank you very much indeed. Things that make sense, things that don't make sense. It's a lot of the latter at the moment. George Abbas, Head of European Equity and Derivative Strategy at BNP Markets 360. Thank you very much indeed. Call 6 looks like this morning. This is where the centre of gravity is in Europe, and as you can see, it's largely positive. We are seeing, obviously, some decent gains coming through for LVMH and for Ferrari and ASML, but it's interesting to see that Novo in and out of positive territory right now. Let's deal with the details of elsewhere. Joe Easton's got that.
So we are seeing a decent rebound in some of these defence stocks at the open of trading. Go. Remember, Rheinmetall giving an investor update later today, so we might get some comments out of them. But broad gains across defence today. Rheinmetall itself up around 3%. Leonardo almost 5%. Saab and Thales also as well. Now remember, this was one of the hardest hit sectors in the sell-off over the past couple of days, given the high valuations and also concerns about the supply chain potentially being struck by the tariff news out of the US. Then in terms of one London-listed stock absolutely rallying at the open of trading was IAG, the British Airways owner. Come down a little bit now. It was up 6% at the open, but down around 15% on a 3-day basis, given it has been part of that decline. Potentially there were some issues around the supply chain news hitting that one yesterday as well, but IAG rebounding pretty much strength across the airline space today and defence as well. Aerospace really strong this morning. Then a bit of news out of the German mid-cap Stabilis. This company over in, or Stabilis perhaps, over in Germany, they've announced a deal with a big Chinese automotive manufacturer. Not too much detail on that news, but boosting the stock today over in the German mid-cap space for Stabilis, up around 6% at the moment. Then another stock catching my eye, Pure Tech, actually declining around 11%. Now this is actually a US-based company based in Boston, but listed here in London. They have got this takeover bid from Nordic Capital, but potentially not as high a bidder price as that was expected. Might be the reason for that. I'll have to dig down into that one. Doesn't seem to be ticking at the moment. Potentially a bit of disappointment around that deal today. Then in terms of the broker moves, we've got Pandora, that one falling 3% as JP Morgan comes down to neutral. Now remember, they make most of those charm bracelets over in Thailand, and Thailand was hit by a 36% tariff from Trump, and that is the reason JP Morgan cuts that stock down to neutral today. And then finally in Switzerland, going the other way, we've got ABB. Kepler Chevrolet likes this one after a 20% decline in the stock over the past month, so they come up to to buy on that one. They reckon the power market concerns are overdone. Come up to buy it on ABB, and ABB up almost 3% in Zurich this morning.
Thank you, Joe. Joe Easton from our equities team. Coming up on the programme, after Wall Street titans blast Trump's latest tariffs, we'll get the latest on that Wall Street pushback. That's next. This is Bloomberg. Welcome back to the opening trade. 19 minutes into Tuesday's session. It feels like a long week already, but we have green on the screen. How's everybody doing today? Tuesday looking a little bit different to Thursday, Friday, Monday.
Who knows? Market started down yesterday, all over the place. Like, who knows? Trump's talking about putting extra tariffs on China. If he does that later on today, market could go all over the place again. You just don't know. And that's what's causing everybody on Wall Street, I think, to be so upset at the moment. They weren't expecting this. They certainly weren't expecting this kind of volatility. They didn't expect it to be this aggressive. And even the bigger names on Wall Street are making big noises, like Citadel founder Ken Griffin. He's a big supporter of the Republican Party. He's a big funder of the Republican Party. He's calling President Trump's latest tariffs a huge policy mistake. Is he going to be listened to? There's plenty of other Wall Street executives out there also criticising the levies. BlackRock CEO Larry Fink, another big name that is out there making his voice heard, and he's not happy. Charlie Wells is joining us around the table. What are these guys saying, and are they being listened to?
I mean, Guy, the honeymoon is over, and it's feeling like the knives are out. And there had been such a strategic silence in the first quarter, right, since the inauguration, and really kind of since the election of, you know, Wall Street titans trying to navigate how to communicate to not only clients, but also to Trump. And it's just been such a sharp turnaround here. And I think the Griffin comments, as you said, were so notable because he is a Republican. He is a mega donor. In the prior presidential cycle, he donated some $100 million.
He didn't think he was buying this. This was not what his shopping list included.
And what he said yesterday, he was at the University of Miami. They were celebrating their, 100th anniversary. And he said that these tariffs are a mistake. They're a tax on the middle class. He said seeing, middle class people have to see their groceries, their toasters, their vacuums go up 20, 30, 40% was wrong. And something else, and this was such a divergence in the comms that we've been hearing from these executives, he told people in that audience that they should reach out to Donald Trump and tell him to step back from this tariff policy. That is incredibly direct, much more direct than the other, C-suite executives that we've been hearing from. And those are not small names either, right? Diamond and his annual shareholder yesterday was talking about this. Larry Fink saying that a lot of the CEOs he's talking to feel like the U.S. is already in a recession. So knives out.
We always knew that tariff policy was going to be painful. The likes of Jamie Dimon and the folks you mentioned already had said that prior to his election. They also said that it's coming with deregulation and tax cuts, and then that was going to be the savior to all this. What's the commentary around that looking like?
I think a lot of this is, that sequencing issue, right, where I think so much of the hope for this administration had been that the good stuff would come first, that you would get that deregulation, you would get that tax policy, and then that would set us up for an environment where, we could cope with some of this, tariff uncertainty. We could cope with some of the more difficult stuff. But that just didn't seem in the first, few months of this administration like that was going to be possible just from a legislative standpoint. And so I think what we're seeing from these executives is, a lot of discontent with how that sequencing has happened. And I think a question, too, is, does this work, right? I think they had a playbook. Executives had a playbook from Trump 1.0, which was Trump pays attention to the stock market. What did we hear Trump and members of the administration talk about over the weekend? They were downplaying what was going on in the market. The Secretary of Treasury talking about how, this is a MAG 7 problem, not a MAGA problem. And so such a change in strategy from the administration. Management is going to have to kind of try to swerve to that.
OK, Charlie, thank you very much. Bloomberg's Charlie Wells with the Wall Street reaction to President Trump. Let's see how bond markets have been reacting to President Trump's trade policies. Bloomberg's Valerie Teitel joins us now with more. Valerie, we've been, what stocks lost, bonds were gaining in the first few days of up close and personal with the Trump tariff policy. But then yesterday looked different. We saw those yields started to climb yesterday. And then we saw some continuation of that at the 30-year this morning. Now I'm looking at the US curve, and we see yields down at the 30-year and at the 2-year. Please help me keep up.
Fast markets, especially when it comes to what happened with the Treasury market yesterday. I think there are still a fair amount of head scratching out there about what's driving us and what does it tell us about markets going forward. It seems to be maybe one conclusion is that this was banks deleveraging in some way, trying to raise cash, so selling treasuries in order to hold more cash on their balance sheet. Another speculation is this was purely just a rotation from bonds into stocks. If the S&P is down 17%, it seems like, maybe a good time to cash in on some wins in your treasury market holdings and buy into the stock market. There's other maybe more macro things we could talk about, like maybe perhaps this was more about deficit concerns, because we also saw the 30-year rise in the UK, which has dealt a lot with that. In some way, the market trying to understand if we are headed into a global economic slowdown with already bloated debt-to-GDP ratios, already bloated government deficits. Is that really the environment that you want to be buying treasuries into? And then lastly, you have to mention the fact that the U.S. government is frankly alienating a lot of the main buyers of treasuries, be it China, be it Japan, the UK, Canada, all of those, some major holders of treasuries and major buyers into the treasury market, perhaps some alienation on that front. And frankly, less dollar trade between those nations could mean that those dollars recycled into treasuries, that doesn't happen at the pace that has previously.
You just outlined a whole range of questions.
I did.
Around what could be moving the trend. This is a reactive market that doesn't know. That would seem to imply that different investors are doing different things. The result may be the same, but for different reasons.
Yeah.
And I'm wondering what that tells us about where we go next, and whether or not ultimately some of those things become dominant and or become less dominant, or whether they're all just in the mix and will be for a while.
Well, I think the one other big take-home is that, yes, we did see this big de-risking happen over the last few days, but we've not yet seen a defunctioning market yet. There has still been a great functioning of the Treasury market, a great functioning of the dollar funding market. We're not seeing strains there yet. Now, that could quickly change, because I think the common phrase out there is that if Trump tariffs stay on longer than you can stay solvent, there will be a big grab for dollar funding. But we're not yet seeing that. And I think that's one thing that maybe we can be a bit more
How long does that last for? How long is that?
Look, some people say for some of these Asian economies facing these massive tariff jumps, it could be by the end of the week that we start to see some bankruptcies, right? So I know we've had many guests on the show today talking about how credit is leading, and I really do believe that. It is going to be bankruptcies. It's going to be these, the bankruptcies along with a big dash for cash that could maybe ignite this risk-off move further.
Yeah. Well, certainly one that we're going to see whether it has legs. If we're looking for a risk-off move today, you're not going to find it in equities. Bloomberg Television walking us through the fact that credit spreads are leading the equity market. Green on the screen across the board. Coming up, we're going to dive into the EU reaction. That conversation next. This is Bloomberg. This is the opening trade. We're 30 minutes into today's session, seeing green on the screen, a rebound across these markets, but not to the same extent that you saw the sell-off. It is worth noting that the Stock 600 higher by about 1.5%. Outperformance, no surprise, in the DAX and the CAC Cameron. Does that actually stay put, though? Yesterday, about 24 hours ago, we were looking at this market and saying there's not one stock in the green. That kind of rebound doesn't have the same breadth to it that the sell-off did, and I think that's pretty consequential.
It's a bounce. Describe the bounce. I don't know how you would describe it. People will talk about dead cats. People will talk about this being just a response to yesterday. I don't know. Has something fundamentally changed? Has something got better or worse? I don't know either. We're certainly waiting to find out what the various responses are going to be around the world. We've talked already significantly about what is going to be happening a little bit later, potentially with China. Let's talk a little bit about what's happening with the European Union. Their trade ministers have closed ranks, signals a readiness maybe to deploy a full spectrum of countermeasures to the United States, including potential taxes on digital companies. This, of course, in response to President Trump's tariffs.
Everything is possible. Everything is possible. We have a wide toolbox, and everything is possible. And at the end of the day, we don't want to use it, but we can use it. And this is, I think, what was most consensual.
I hope Mr. Trump is smart enough to know that our economies are very much connected and that we depend on each other, and that tariffs are very bad for all of us.
I know that 27 are stronger than 1, and so if we keep united like we do for the moment, I'm trustful that at the end of the day we'll find a good compromise.
How united is Europe right now? Different views seem to be being expressed in different capitals around the continent. Europe doesn't feel ready to maybe go down the road that China has gone down at this point. Let's get a sense of where we are in this journey. Oliver Crook joins us now to talk us through what we got yesterday. Was there a breakthrough yesterday, or are we still hedging our bets within the European Union, Ollie?
Yeah, I think hedging the bets is the right way to put it, Guy. I think at the moment what you're seeing is you kind of have the spectrum of sort of China on the one end, the UK on the other, and the EU kind of trying to play slightly closer to the sort of UK side of things, whereas China's going sort of all in, retaliating against the United States. You're seeing the same thing sort of in Canada. EU is really trying to give himself maximum flexibility. What we understand from the conversations yesterday is you have Plan A and you have Plan B. Plan A is to negotiate, to try to bring things to the table and basically not escalate the situation. You heard the term de-escalation from most of the trade ministers you spoke to, but when you press those trade ministers, and I asked them, a number of them, do you have any idea what exactly the United States wants from the EU, what the non-monetary trade barriers are? They say, no, not really. Have you had any contact? Has there been any sort of willingness from the United States side to negotiate? They say not really, which brings us to the Plan B, which is the full sort of retaliation and the menu of options there. What those could include, we've talked about them before, are basically taxes on the U.S. tech company, the so-called anti-coercion instrument, that sort of piece of legislation here in Europe, which is sort of the nuclear option on trade that they could deploy. But what we are expecting now is to have some slight retaliatory measures. That's just to the aluminum and steel coming into force next week. That is going to be pretty modest. But again, I think what I was most struck by in talking to these trade ministers is how little contact there is right now between the United States and the EU in terms of negotiating any sort of deal on tariffs.
So, Ollie, in this market, when they're digesting all these headlines coming from the European Union and around the world, there's an argument that good news in this market can come in the form of retaliatory tariffs that are not as strong as the ones that Donald Trump imposed on the rest of the world. Where does the EU stand on that? Are we seeing any element of retaliating with less than expected?
So you're seeing a little bit of signs of that just in terms of how they're going to approach the steel and aluminum tariffs. I think that'll be pretty interesting. As we've been reporting overnight, bourbon has apparently been axed off of the list, but we do expect there to be measures on things like motorcycles, diamonds, boats, household appliances, tobacco, poultry, those sorts of things. Those will come into force next week. What is also interesting is despite the fact that these tariffs will come into force on April the 15th, they're not going to actually start collecting them until May, right? So this is sort of the whole idea of giving as much ample opportunity, as much runway to negotiate. But again, I think what is going to be very sort of decisive in all of these conversations, both for the Trump side and for the European side, are the markets. Are the markets going to push either Trump to the negotiating table, have a little bit more strength to the EU side? I asked a number of the ministers if they think the markets are on their sides. When you see these sort of huge drops that we've seen over the last few days, they wouldn't really sort of bite on that. But I think that is going to be the fundamental reality and the dynamic of who needs to come to the negotiating table, and everybody right now is just waiting.
Oliver, thank you very much. Bloomberg's Oliver Crook with the latest on the tariff conversation, how it's playing out in Europe, what Europe is responding to and what it is not. Let's think about the market's reaction function to tariff news. Edward Kolb, multi-strategy equities head at Man Group, joins us. Ed, very nice to have you with us this morning. I just want to get your sense of the latest signals that we're getting, because yesterday's price action made it clear that the market is really clinging to all messaging around tariffs. So we jumped higher on the speculation we might get some kind of pause. Then that was denied by the White House and stocks dropped. So with that in mind, I'm drawn to some of the clues we're getting about whether this is to be negotiated away or not. And we heard from Scott Bessent talking about, the US administration is talking to lots of countries here, tens of countries. But then Peter Navarro saying this is not a negotiation. What is it that the Trump administration can say about tariffs and negotiations that will calm markets, do you think?
I think the first thing we all have to embrace is humility. The range of possible outcomes here is enormous. This is a thunderbolt, right? I mean, this is not what we used to receiving is a signal from markets, and that means that the range of scenarios is absolutely enormous. I think it's probable, as your report is saying, that negotiation is a big part of this, but we have to keep an open mind that in the end this is punitive rather than about negotiation. The way I think I'm thinking about this is that there is one person whose policy matters here and one person only, and that is Donald Trump himself. So all of these other policymakers that we hear, all of the other actors in the US administration that are kind of floating trial balloons about a potential change in direction in policy, my view would be you ignore them. They don't matter, right? And a really interesting way to think about that is to think about the analogy of China for the last 3 years, which has been trying to stimulate its economy and stabilise it. We've had 3 years of relatively minor policymakers telling us about stimulus, and none of it mattered until the big man stood up and said it, right? And I think that's the world we're in today, which is as long as Trump is calling the shots on the direction of policy, and it seems to be the case that he decided very, very late in the day about how universal these tariffs would be. That was him. As long as that's the case, and I think it will remain the case, I would be a bit tempted to fade the idea that there's a rollback, and that's being communicated by other members of the administration.
Okay.
As to the price action, I mean, the way we look at this is the markets are in because of the thunderbolt, markets are in full capitulatory mode, right? We've had a complete, from an economic perspective, a shift in policy that breaks down 50 years of global order and 35 years of trading arrangements. That is being discounted in a disorderly way by markets to some extent. That when you get capitulation, and there are various ways of looking at it, and we've got some pretty good measures that suggest this is as extreme as COVID, when things got really, really messy in that week in March in COVID. Yep. When you get capitulation like that, it's not unusual then for things to become very, very volatile the other way, right? Because you've had this sort of extraordinary purging of positions. Things become kind of quote-unquote clean because there's been an overreaction. Overreaction to some extent. We don't quite know what we've overreacted to yet. And at which point the sort of sensitivity and the sensitivity to headlines becomes extreme.
This feels like we're going to go through various phases, though. And I don't know which phase we're in and kind of how many more phases there are to come. Goldman Sachs is out with a nice note this morning. Peter Oppenheimer and Sharon Bale talking about the fact that we're currently in an event-driven bear market. So we're very reactive to what is going on around us. But we've not yet gotten into a cyclical bear market, but we could get into that as a result of where we are now. And that's a different kind of phase that we would enter. Is that a fair way of describing kind of where we are? At the moment, we're really reactive. But as we start to get structural change, then a recession becomes a greater probability. And that's a more manageable, understandable, but not necessarily less damaging event that we could, or maybe more damaging event that we could ultimately get into. Is that how you see things progressing?
Yeah, I think that's a reasonable way of thinking about it. I mean, where we are today is panic and reaction, maybe to some extent overreaction. And where we're going, I fear, sort of almost irrespective of whether Trump reverses or not.
Yep,
I mean,
exactly. Yep.
I don't believe he is going to return to where we were before Wednesday last week. So bearing in mind the probability that there will be some degree of lasting disruption to the way the world's economic order functions, it is probable now that we're going to have a recession. The major mechanism, I think, is going to be at play here. I mean, there's some really deeply painful things that are going to happen, right? I think you think about really undeveloped nations, which is not typically what we think about in financial markets, but there are countries now with big trade deficits big trade surpluses versus the US, whose government tax revenues are all dependent on excise duties. They're now going to have to try and fund themselves. That's really going to be a human catastrophe. Closer to home, in developed economies, we're going to have to think about the fact that opacity in the corporate sector is as elevated as we can imagine it, right? I've used this word thunderbolt, but think about thunderbolts we've had in the past. Think about the GFC. What happened during that period was that all governments everywhere in the world came together to cooperate. We had central bank swap lines to make sure that markets stayed liquid. We had coordination on fiscal policy. We had coordination on bad asset relief. COVID was the fastest imaginable coordinated response. I mean, the way that the Fed stepped in March 2023 in a coordinated, March 2020, in a coordinated way with other central banks to buy assets, to backstop markets, was extraordinary in its speed and coordination. We're now in a world which is not going to be coordinated. This is multipolarity. And so I think that the danger here is that the opacity that businesses are facing, where the return they expect to make on capital, the questions they have about whether they have enough inventory, the questions they have about whether or not their capital stock is located in the right place, the impact that has on margins, the impact that has on the return they make on capital, all of these things, I suspect, are going to force them to shed labour. And that's pain for households, right? And that ultimately is the kind of thing that drags the world down into a recession. So I'm a bit concerned, and hopefully this is just the cortisol of the last week talking, but I am a bit concerned that it's going to be too late to put the genie back in the bottle.
You paint a grim picture, I have to admit. But I think if there's a positive sense in this, and you mentioned it yourself, is that the markets have been quite orderly about this. And we've heard that time and time again from every guest that we've heard. You draw the COVID example of this fact that you had so much liquidity support from every corner of the world. What is the tell for you that the system at its core is showing cracks?
Yeah, I mean, it's a good point. Everything we can see, and you know, we trade an enormous amount of dollar notional, and our trading desk tells us that things are orderly and we can transact. And so that's a good thing, right? Markets are working. I think that, you know, everyone will be on the lookout for bodies. These are typically the sorts of event where after a period of time, some kind of body floats to the surface. Yep. And obviously, so far, there's nothing. But really, I guess the things we look at are, you know, liquidity, the sort of depth of markets, the bid-offer spreads to get a sense of, you know, how much things are widening in order to transact, and then credit as well, your ability or not in less liquid markets to transact. And at the moment, you know, things are pretty orderly. So I think that's a testament to things functioning. So that's good, because we don't seem to be in a systemic crisis from a markets perspective. And that would obviously, if that occurs, that spills over to worsen my grim picture of what can happen for the economy.
We have to end the show with a little bit of positivity. Or getting towards the end of it. Thank God for you. Ed Cole, multi-strategy equities head at Man Group. Painting a grim picture, a little worried about what comes next, but saying whatever it is, the markets can survive and are pricing it.
Yes, and what you might need to survive is our show, all shows on Bloomberg TV, and a newsletter about markets. That might help. So you might want to check out the Markets Daily newsletter from Bloomberg. It's what's happening in stocks, bonds, currencies and commodities right now. It's also where they are going next, of course. Sign up for that at bloomberg.com/newsletters.
OK. Let's talk about some of the areas that we're watching in terms of the sector story yesterday. Yesterday was unbelievable. This time yesterday, defence stocks were being absolutely battered. Today we see something of a rebound, but not enough really to compensate for the moves that we saw yesterday. But such volatility. And this is an area in theory that should be backstopped by huge government spending. But the market obviously had run this sector very, very hot for a few weeks, Kriti.
Absolutely. Another sector that was getting hit very, very hard yesterday, just 24 hours ago, were the bank stocks. Today, you are seeing a little bit of a rebound, but not necessarily across the board. These are the four that got hit the hardest yesterday. UniCredit not getting on the rally as much. You're seeing that in the periphery. I'm curious to see how that all shakes out. Much more ahead. Stick with us. This is Bloomberg.
There is no precedent, to be clear, for this situation. In a normal crisis, pretty much the governments and the central banks trend to rush to bail out the market. And now, for the first time, we have the US administration somewhat opposing the market. So there is no put from Trump right now. And without the put being triggered, yes, I think we can go down, and there is nothing to stop the market to price a recession.
Many account. Barclays, head of European equity strategy, talking about the puts, the various puts that are out there. The Trump put, is there a Fed put? Can we navigate a big financial crisis without the Fed kind of backstopping us? I think is a really key question as we try and understand what is going on here. Let's bring in Bloomberg's Valerie Teitel and Michael Masika, who leads our EMEA equity markets and strategy coverage. Michael, I'm going to start with you. Equities are up a little bit this morning. What do you make of this?
Well, Guy, what we're hearing is it's not very convincing. Volumes are still low. There's a bounce because we had like a very sharp sell-off over the past few days.
Yep.
But at the end of the day, it's like you dip a little bit, but it's not like a proper buying the dip action that we're seeing.
And Michael, in terms of the themes that are being traded, it seems to be a sort of reverse of the themes of the month to date. So month to date, we saw anything that was growth sensitive dropping, and anything that was interest rate sensitive and could benefit from weaker growth was rising. Today, we just see a little bit of a reversal of that. I mean, is there anything new in the action today? It's just a little bit of a reversal of the last few days.
No, I think it's a bit of a reversal indeed. But the past few days we have seen also like very indiscriminate selling. So you had like pretty much the whole market that was selling off. I mean, even like defensive sectors like pharma or whatever, just like everything was down and heavily down. So we're seeing a bit of reversal, of course, but at the end of the day, it's still really not convincing. We have a lot of the hedge funds still selling. The exposure to global equities is very high still for CTAs, for example.
Yeah.
They expected to keep selling this week, keep selling next week and over the next month. And Goldman Sachs are like about a 98 billion worth of global equities to be sold over the next month, regardless of like market price action. So it's it's not looking really great for the near term.
So Val, you a lot of optimism on this show.
Sorry,
I wasn't ready. Val, hop on in here, because in the last kind of 24, 48 hours, we've heard so much from so many people saying that the equity markets are following the credit story more. That's in the past. Is that what drives these markets moving forward?
Oh, look, I think it very much drove the rebound today as well. We didn't see a gap wider in high-yield credit spreads at the European Open. You know, they gapped narrower, so I think that's what helping the bank stocks rebound. But, I mean, I would just remind everybody that during a time of crisis, sometimes the up days are even more confusing as the down days. You know, it's definitely not out of whack that we would see a very positive rebound after a big equity market slide. I mean, if you look back at history, sometimes the biggest rallies in the equity market take place right after the biggest falls. So, you know, this could be, to Michael's point, you know, the calm before the storm continues.
Okay, let's talk about where potentially the next storm could come from, and let's talk about China. Trump is saying that Chinese tariffs, the response to the response, I don't know where we are, but basically...
Over 100%, I think.
Basically, there's the possibility of China tariffs going to north of 100% today if we don't see the Chinese removing the 34% they put on, which was in response to the reciprocal tariffs which were added by Trump last week. Is that the potential next storm? And the Chinese seem to be warming up, pulling some, hinting at some big levers that they can pull as well.
Yeah, I think maybe the next stage in the storm could be a big CNH deval, a Chinese yuan deval. If we look back about the previous Trump 1.0 tariff fight, they devalued their currency by 10%. And something like that, a big one-day move in the fix, you know, let's talk over 1% devaluation in yuan, could really start to spark concerns, not just from foreigners holding Chinese assets, but foreigners holding any Asian assets, because dollar Asia really very much follows dollar CNH. If we see CNH weaken, these Asian economies who are going to be attempting to hold on to capital might see the beginnings of a capital flight when they're already dealing with the higher tariffs, you know, rolling out in March. So that's rolling out on Wednesday, excuse me. So that's one thing I'm watching, at least in the Asia session, if there's this big move on the CNH fix from the PBOC.
Michael Masika, I should say. Sorry.
We just call him Masika.
I'm going to start calling him
that's what he's known as.
It feels like our friendship has.
We need efficiency right now.
Yes, quickly. Well, Val is talking then about like where you do want exposure and where you don't want exposure. And one of the big comments here on the show has been that a lot of the unwind that you've seen in the equity market has been an unwind of hedging, very specifically, but that there's little appetite to hedge moving forward. It's kind of a just retreat from the market dynamic. Are you seeing evidence of that this is really a hedging unwind, not just in maybe the equity market, but cross-asset?
Everyone was really maxed out coming into the year. The cash levels of funds are very, very low. They're still very low. There is a point where you need to deleverage. You need to protect your capital. You need to exit some of the parts of the markets. We were talking earlier about, like, is there a put in this market? Is there a Trump put? Is there a Fed put? Maybe there is. And we've seen yesterday, we could be one headline away from like a bounce. I mean, the fake headline yesterday was like already showing that the market is ready to buy, but we need clarity. Without the clarity, and we don't have any at the moment, that's not going to happen.
Yeah, and so I'm interested in what news flow around negotiations can be meaningful, because obviously the news of yesterday was pushed back and the market shouldn't have responded to it. But we will at some point get some news about some negotiations. Unlikely, it seems, that it comes before imposition of tariffs, but in the months after that, maybe we get news about negotiations. You know, Japanese stocks up substantially after selling off a lot yesterday, but they made back nearly all of the losses of yesterday in today's session on news that they could be near the front of the line, the queue on negotiations. Is it that kind of news flow that's going to help?
Exactly. This is the clarity we need, because the thing is, like, once you have clarity on how much is the tariff, how much the economy is going to suffer or not suffer, then you can tell, okay, this is how I price my stocks, this is how valuations should evolve, this is where the EPS is going, and that's when you can assess your exposure.
Val, how are people thinking about the Fed put? Let's talk about the puts. At the moment, so Goldman Sachs has got this nice note. They talk about being in a reactive phase. We're reactive right now.
Definitely.
That's kind of where we are in the market. But ultimately, we may end up in a recessionary phase of this, and that will be much more easy for the Fed to manage. Is the Fed just going to basically wait until it sees that kind of action before it can take any kind of remedial, before it can put the put into place?
The Fed put isn't there until we see weakness in the labor market. If you look at how the things we've heard from Fed speakers lately is that they respond to the target that's missing the most. And right now it's inflation that's missing the most, not the unemployment rate. So they are there to protect inflation until
we manage
weakness.
a financial crisis without the Fed until we get to that recession?
Well, look, if you look at the past few crises, we've always had the Fed step in immediately or during the crisis, and this is probably why we're seeing such big bruising in the equity market, because they've woken up to the reality that the Fed isn't there until we see the unemployment rate go higher. And frankly, most people think that's not going to happen until the summer.
Valerie, thank you very much indeed. Michael, thank you very much indeed as well. Valerie Teitel, EMEA Equity Markets Lead. Michael Masika, thank you very much indeed.
Coming up in just over half an hour, we're going to be speaking to the Hungarian Foreign Minister. And of course, this is interesting because the Hungarian delegation, standing aside from the rest of Europe in some of its commentary around the Trump administration and the European reaction function to tariffs. So don't miss that interview, 9:30 a.m. London time.
Of course, another one to keep an eye on. Of course, later today, we're going to speak with former U.S. Treasury Secretary Larry Summers to get his take on the tariffs and the market volatility. That conversation happening at 4:10 p.m. in London. The equity markets are higher. Let's see if they stick. That does it for the opening trade. The Pulse is up next. This is Bloomberg.